Markets are rarely driven by logic alone. Behind every boom, bubble, crash, and rebound lie two powerful emotions: fear and greed. These emotions shape investor behavior, amplify trends, and create the predictable swings of economic and financial cycles. Understanding the psychology behind these emotions allows investors to navigate volatility, anticipate turning points, and make rational decisions when others panic. In this video, you will discover how fear and greed control markets and how mastering them separates successful investors from the rest. Like and subscribe to gain insights that turn emotion into opportunity. 1. Fear and greed as invisible market forces. Human emotion is the hidden engine of markets. Greed drives risk-taking, optimism, and speculative buying, while fear triggers panic, selling, and risk aversion. These forces create cycles in prices that appear irrational but are highly predictable in their patterns. Investors often mistake market movements for purely economic causes, ignoring the human behavior that magnifies trends. For example, during a bull market, greed encourages overconfidence, speculative bubbles, and rising leverage. 2. Greed, the engine of expansion and speculation. Greed drives expansion. When markets rise, investors are drawn to opportunity and potential profit. Optimism spreads rapidly, and enthusiasm creates momentum that often outpaces underlying fundamentals. Historical examples include the dot-com boom or real estate bubbles, where greed drove irrational valuations. Investors respond to greed by increasing risk exposure, often overestimating future returns. While greed can create opportunity, it also produces vulnerability. 3. Fear, the catalyst for market contraction. Fear dominates during downturns. It is amplified by uncertainty, losses, and negative news, leading to panic selling and herd behavior. Fear can drive prices far below intrinsic value, creating extreme opportunities for prepared investors. Yet most react emotionally, selling in distress and locking in losses. Fear is powerful because it operates unconsciously, influencing decisions before rational analysis occurs. 4. Herd behavior and emotional contagion. Markets are collective phenomena, and human beings are social by nature. Herd behavior amplifies both fear and greed. Investors imitate peers, following trends without independent analysis. Greed fuels crowded trades and bubbles, while fear triggers widespread selling during downturns. This emotional contagion magnifies volatility, often creating extremes that are disconnected from fundamentals. 5. The feedback loop of emotion and price. Markets and emotions reinforce each other in a continuous feedback loop. Rising prices fuel greed, which drives further buying, while falling prices trigger fear, accelerating selling. This loop explains why markets often overreact in both directions. It also shows why short-term price movements often appear irrational. They are the result of compounded psychological forces. 6. Cognitive biases that amplify fear and greed. Psychological biases distort perception and exacerbate fear and greed. Loss aversion makes investors overreact to losses. Overconfidence encourages excessive risk-taking. Recency bias exaggerates the importance of recent gains or declines, and confirmation bias reinforces pre-existing beliefs. These biases cause irrational buying during euphoric periods and irrational selling during panics. Awareness and counteraction of biases are essential. 7. Contrarian. Investing capitalizing on emotional extremes. Fear and greed create predictable extremes. Contrarian investors act opposite the prevailing sentiment. When fear is widespread, assets often trade below intrinsic value, creating opportunities. When greed dominates, valuations may become excessive, signaling caution. This approach requires emotional detachment, patience, and rules-based strategy. Contrarian investing is effective because it leverages human psychology, the predictable overreaction of the crowd, to generate outsized returns while avoiding costly emotional mistakes. 8. Systems as shields against emotional decisions. Because emotions are powerful and unpredictable, relying on intuition alone is risky. Systems and rules protect investors from impulsive decisions. Predefined asset allocations, automatic rebalancing, stop-loss mechanisms, and structured investment plans reduce the impact of emotional swings. Systems convert discipline into habit, ensuring rational behavior during periods of extreme fear or greed. By embedding structure into investment practice, markets no longer control the investor. The system guides behavior, preserving capital and allowing opportunities to be seized consistently. 9. Market sentiment indicators as psychological tools. Indicators such as volatility indexes, investor sentiment surveys, put-call ratios, and fund flows reveal the intensity of fear or greed in markets. Extreme readings often predict turning points before they are evident in prices. For example, a volatility spike may signal peak fear, presenting a buying opportunity, while euphoric sentiment may indicate the tail end of a bubble. These tools transform emotion into data, allowing investors to quantify sentiment and make informed decisions. 10. Mastering fear and greed for long-term wealth. The ultimate advantage in markets comes from mastering the emotional cycles of fear and greed. Predictable emotional swings create opportunities for disciplined investors who combine knowledge, patience, and systems. Markets will always fluctuate, but understanding the psychology behind those fluctuations allows one to act strategically. Those who control their own reactions and leverage emotion instead of being driven by it consistently outperform those who chase trends, panic, or follow the crowd. Fear and greed shape every market cycle, driving both risk and opportunity. Understanding these emotions allows investors to anticipate extremes, act systematically, and preserve capital when others panic. By combining insight into psychology with disciplined systems and strategic positioning, market volatility becomes a tool rather than a threat. Like and subscribe to continue learning how to harness fear and greed for predictable long-term wealth.